Major banks kicking off earnings today. We are awaiting Citigroup top of the hour. JPMorgan Wells Fargo reported results earlier. Joining us now, Macrae Sykes, Gabelli Funds Portfolio Manager. Matt, great to have you with us. Wells Fargo is down almost 6%.
Yeah.
Why?
So a couple things there. I think the top line, the NII came in a little lower than expectations at 11.9 versus 12.3 kind of estimate. So I think that was a disappointment. Number two, I think the street was looking for an increase in potential guidance from down 7 to 9%. They reiterate that the guidance will be at the low end, down 8 to 9%. So I think that was a disappointment. I think there's probably some conservatism in that, which we have seen. And then a little higher expenses, but partially that was due to kind of higher revenue from markets, so not unexpected. So when you put it all together and some expectations, plus the stock being up 20% year to date, it's not surprising it's down a little bit, but we still see good value there, 1.4 times.
Right, and that's really sort of the problem, if it's a problem, the run-up of the banks into this earnings season. There's so many expectations, revolving around, a potential trough in net interest income. There's expectations that capital requirements will be alleviated for a lot of the banks, and so there's a lot built in here. Right. For JPMorgan, though, why is that stock? On the headline numbers, it looked fine.
Right.
Why is it down this morning, do you think?
Well, we'll have to see the guidance there, too. And in the commentary, we've already seen, worries about interest rates and inflation, et cetera, global macro. It's just their conservatism. But, the ROTCE at 20%, just incredible. Great execution, great capital management, loans doing a little bit better as well. So, and investment banking up 46%. Markets, all these things were doing better than expected. So the execution's there, but at 2.3 times tangible, it's quite a premium valuation. And even Jamie Dimon has said, well, we're going to be reluctant to buy back shares here. So I think a lot of that good news is baked in. And as you say, that the run-up, kind of anticipated these results. Right.
In terms of rate cuts and the expectations, 90+%. Chances of a rate cut in September.
Right.
And the path afterwards is a little bit uncertain, and some are saying that maybe we're not even pricing enough in later on. What is your sort of expectation for that? And do we need that backdrop in order for you to be as constructive as you are on some of these names?
Right. Well, the predictions around rate cuts has certainly been very volatile, and we seem to swing one way or the other. It does seem like, given the CPI print and all the economic news, that we're pretty baked in for September, and then we'll have to see. There's some political dynamics related to Fed policy, et cetera, towards the end of the year, as you can imagine. But what we saw at the beginning of the year, when we had anticipation of those rate cuts, we saw this kind of rotation of the smaller regional banks that lifted off, and then it kind of retrenched. And then we saw the better performance by the big banks going forward. And yesterday we saw kind of a seismic shift there. So perhaps, just given the relative performance with the big banks up 20%, the little banks, smaller banks underperforming, but more dependent on the rate and normalized yield curve, that you could see some of that inflection point and change going forward. So I think that's something to watch. But again, I don't know how to predict interest rates and never have. We try not to do that. We look at a bottoms up fundamental research component. But certainly lower interest rates going forward would be a benefit to the banks.
So basically, if I were to tell you today that there are more rate cuts to come and that the market's underpricing the number of rate cuts, you would say go to the region. I mean, the regionals would obviously benefit, as you pointed out, but should there be a shift, a reallocation more towards the regionals? And a name like a Bank of America would benefit greatly in terms of its book with a decline in rates. Right.
So there are a number of factors with lower rates. I think it would take some pressure just on the economy, help friction there. The outlook for reinvestment in terms of CRE, et cetera. So, opening up capital markets, and then deposit costs, which have, screamed up the last couple of years. That would take some pressure off of that. And so a normalized yield curve eventually is very good for banks as opposed to this inverted one. And then, the last component being, what do we do with individual credits? We know there's a great revaluation and refinancing that's going to go on just given the decade we have of rates. So to the extent that, you have to still go house to house, check out their CRE concentration, multifamily, et cetera. Right. So ultimately it should be good for the banks, but you still have to do your work individually.
And just quickly, I want to touch on FTAI Aviation because I thought this is really interesting.
Right.
Huge run up in the stock. It's an aerospace leasing company. So you wouldn't think that it'd be in your fund. But it does lease, so it's a transaction.
Right. So we have 80% of our concentration financial services, 20% we're allowed to use other things to put in there. FTAI was a closed-end fund run by Fortress, infrastructure investments. They've narrowed that focus to aviation, so traditional leasing business. So it's really an alternative investment firm. But they've had an impressive operating segment on this MRO business. It's taken off. There's 25 million of EBITDA. They're hoping to do 500 million plus going forward. So that's been the catalyst behind the huge run up in the shares. It's been a bigger concentration of us just given the outperformance. So there's huge taxable gains in that just given what's happened. And so we're sort of managing that as we grow the fund.